Okay, so accounting 2242. So this is an overview of Chapter 8, which focuses on short-term business decisions. When you're looking at short-term business decisions, you only want to consider relevant costs. So you're only going to look at cost and revenue information that's changing. And any costs that don't change between two alternatives, you ignore it. And some costs, in other words, costs that have occurred in the past, again, if they can't change it, then that becomes irrelevant as well. So there's also some sort of non-financial factors that you also have to consider when you're making decisions. If you decide to lay off employees or outsource or discount prices to select customers, all of that can have long-term negative impact on the organization. I'm not saying not to do it, but when you do it, you have to consider the consequences. So if you ignore those qualitative factors, this can lead to very serious mistakes. So we are going to be covering in this chapter these 7 types of short-term decisions. So pricing, special orders, dropping a product, a department, or a territory, looking at product mix when you sell 2 or more products, outsourcing, whether you should make something or buy it, selling something as is or processing it further, and then, presumably selling it for a higher price, and then transfer pricing decisions. So when you're looking at relevance, say for instance, if you were going to buy a new printer, so obviously the price of your new printer is relevant, but the price you paid for your old printer, it's irrelevant. The money has been spent, so it's a sunk cost. Unless you can trade in your old printer. So the trade-in value, that's what would be relevant, not the value you paid for it. Paper, irrelevant. You're going to be using the same amount of paper on the old printer and on the new printer. However, if there's a difference between the cost of the ink cartridges between the old printer and the new printer, you would have to include the price difference between these cartridges. So when you're looking at pricing, there's price takers and price setters. So price takers, here you have a situation where the product lacks uniqueness. So think about a liter of milk. You pretty much have a lot of competition, and in that situation, you're going to have to keep your price in line with the competition. However, on the flip side, price setters, here's when you have a product that's unique. There's less competition, and the pricing approach here, you look at your cost plus pricing. Whereas if you're a price taker, you have to look at your target costing, and I'll go through that shortly. So pricing decisions, if you're a price taker, you have to look at the price you can charge for your product, then you have to get your costs down to allow you to sell that product for a price that's profitable. Whereas if you're a price setter, you can take your cost of your product, add in your desired profit, and then determine your price from there. So cost plus pricing. So say if you are selling 250,000 units for $1.50 a unit, your variable cost is $375,000. And you might have fixed costs of $325,000. So total cost, $700,000. And typically, most businesses would have a desired revenue. So they might want to make a certain return on their investment. So if you have $1 million worth of manufacturing assets, you might decide, I want 10% return, so $100,000 profit here. So that would bring you up to a total revenue of $800,000. So $700,000 to cover your costs and $100,000 for your profit to give you $100,000. So you're going to be selling your 200 and 50,000 units, so 800,000 divided by the 250,000, that tells you the price is going to be $3.20. So, but if the current price is $3, can they charge $3.20? Well, it all depends if you're a price setter or price taker. So here, if you are a price taker, what happens here is you have to sell your product at the market price. So looking down here in the calculations section, if you're in a competitive market, you can't charge $3.20. You can only sell it for $3. So this means your revenue is going to be $7.50. Then you want to subtract off your profit, desired profit of $100,000. So what this means is your product can only cost you, those 250,000 units can only cost you $650,000. So you're kind of working backwards. You're looking at your cost and seeing what you've got to get that cost down to. So there's only two ways really to get your cost down. You either reduce your variable cost or your fixed cost. So in the first example, you start with your $650, your total, that's the maximum your cost can be. Then your variable cost, if you don't change those, it's $375. So it means your fixed cost can only be $275. Or you can do it the other way and reduce your variable costs. So here we have a total cost target of $650,000. Our current fixed cost is $325. So this means your variable cost can only be $325,000 divided by your $250,000. So each unit can only cost $1.30 per unit. So when you're looking at other short-term decisions, one frequent one that businesses encounter is a special order. And when you're looking at special orders, you only look at an incremental analysis. So you focus on what revenues and expenses are changing. And you also have to consider the contribution margin in order to separate the variable costs from fixed costs. So an example here of a special order is if you have a customer and they might want to buy one of your products at a reduced price. So they're saying, look, I'm going to buy like 10,000 units of this widget, but because I'm guaranteeing you the sale, you don't have to do the marketing and all of this, so I'm expecting a reduced price. So the first thing you have to do when you get that type of offer is, do you have the capacity to do it? If yes, okay, you can start to think about it, consider it further. If you don't have the capacity, you probably want to reject it. So here you look at more of a qualitative type of consideration. If you go ahead with the special order and sell your product for a lower price to one particular customer, will this affect regular sales in the long run? If no, then you'd accept it. If yes, you'd reject it. So overall, the idea here is with a special order, if you think it's not going to have a negative outcome for your long-term sales with your regular customers, if the increased revenue exceeds the increases in variable and fixed costs, you'd accept it. Whereas if the increase in revenue is not sufficient to cover any increase in cost, then you reject the offer. Kind of common sense, really. So here, if you have a special order, for example, to sell 20,000 oil filters at $1.75 each, that would give you $35,000. But of course, you've had to manufacture those, and that's going to cost $1.20 each, $24,000. So it seems like a pretty good idea because you're going to increase your income by $11,000. Yeah. But sometimes when you take on a special order, or if you're thinking about taking it on, and if you're already at full capacity, what you have to think about then is the opportunity cost. So if you're already making as many products of something that you can possibly make in your manufacturing facility, if you're to take on the special order, this means you're going to have to not sell some of the product to existing customers. So in other words, there's opportunity cost because you've lost the opportunity for sales to other customers. So is that wise or not? So with the special order, so here with this one, you have potential for an increase of 60,000 units for 24,000, and their variable cost 21,600. So you could increase your operating income by 24,000. But sometimes the special order may actually require a small investment in some fixed manufacturing costs. So in this particular example, they're going to have to increase their fixed costs by 2,000. So that really limits the profitability here. So the increase in operating income now would only be $400. So, do you want to take all those risks for $400? Probably not. So other short-term business decisions that managers face is sometimes you might have multiple products or departments or stores or territories, and you want to look at the profitability of each of those to see if maybe some should be dropped. The other area you consider is product mix decisions, when to outsource and when to sell or as is or process further. So when you're looking at dropping a product or a segment, again, you're looking at, does this product provide a positive contribution margin? So contribution margin, you'll recall, is your selling price less your variable cost. Then you got to think about, will your fixed costs continue to exist even if you drop the product? Or are there any fixed costs that can be avoided if you drop the product? Will dropping the product affect sales of other companies, of your company's other products? So maybe people wouldn't bother to come to your company if you dropped one of the products because they want one-stop shopping. They come and buy both products. And if you decide to drop a particular product or department, what do you do with the freed up capacity? Is there a way to utilize that? So typically, when you're trying to figure out if you're going to drop a certain product or department, you want to take your total and you want to break it down by, in this case, by product line. So on a total basis, the operating income here you'll see is $105,000. But when you start digging into this, drilling down, you can see that the air filters, they're quite profitable. They're giving you an operating income of $124,000, but the UV air cleaners, they are actually showing a loss of $19,000. So should you drop the UV air cleaners, don't be too hasty to say yes, because you need to do a little bit more analysis before you say yes. So what you want to do here is, will the total fixed costs continue to exist even if the product line is dropped? So here, you're going to, if you drop the UV air cleaners, you're going to lose the revenue, of course, of $35,000. But then again, you're also going to avoid the variable expenses of $30,000. But so by dropping it, you're actually decreasing your operating income by $5,000, because in this particular analysis, the fixed costs are going to continue to exist. So that's not always the case. Every problem will be different. So when you're doing these types of problems, you'll be told that whether the fixed costs will continue to exist or if they could be reduced. So now a second scenario, same thing, except for now you're looking at the possibility that you can reduce your fixed cost by $13,000 because you're not going to need the supervisor for the UV cleaners. So that means you're having your revenues decrease by $35,000, but your expenses are going to decrease by $43,000. So this is a good decision because if you drop it, you would be actually increasing your operating income. So this is fairly typical. When you can't reduce your fixed expenses, generally it's probably not going to be that profitable overall for the company to drop the product line. But if you can reduce your fixed expenses, even if you don't reduce all of them, just by a portion, as you can see here, it ends up putting the company in a profitable position. But you've got to consider the qualitative factors. So if you drop a certain product, is that going to affect sales of your other products? And again, what are you going to do with that extra capacity? Can you utilize that to produce something else? So the decision rule about dropping a product, a department, or a territory is if the revenues lost exceed the cost savings, then you don't drop. Whereas if the cost savings exceed the lost revenues, then you would drop it. So product mix. So you have to look at what is the best combination of products to sell, like how many of the different units of products should you sell. And this is really based on the contribution margin per unit of constrained resource. So you have a company that makes shirts and jeans. So on the surface, you see that shirts, they have a contribution margin of $18 per unit, and jeans $12. So you'd say, oh, well, we should just produce more shirts and not as many pairs of jeans, or maybe not even do jeans. Seems like shirts are more profitable. But are they? You have to do a little bit more analysis to figure that out. So here, the constrained resource is time. So you can make 10 shirts in every machine hour, whereas you can make 20 pairs of jeans. So even though the shirts have a higher contribution margin per unit, you can actually make more jeans than you can shirts. So if you can make 10 shirts in an hour, your contribution is going to be $180, whereas if you make jeans, you can make 20 pairs. So you're only making $12 per pair, but you're making 20 pairs, so that gives you $240. So it's more profitable to be making the jeans versus the shirts. So the decision rule, again, emphasize the product with the highest contribution margin per unit of constrained resource. So it's not per unit of the product, it's per unit of constrained resource. Outsourcing, this is a very common decision that organizations have to make. Should they make something or should they buy it? So, you know, if you're selling a product, or so, do you produce it in-house or are you going to buy it from an external source? And again, it's a matter of considering the best way to use your available resources. So you want to compare your variable cost, your internal cost to make the product compared to the cost of outsourcing. You also want to consider, can you avoid any of your existing fixed cost if you do outsource? And then again, the usual question, what are you going to do with the freed capacity? Can you make something else? So when you're looking at a total cost for a product, so the total cost includes your materials, labor, variable cost for your overhead, and your fixed manufacturing. So you have total manufacturing costs of $125,000, and you make 250,000 units. So the cost per unit is 50 cents per liner. So if the company receives an offer from another company to make that product for you, and they're only going to charge you 37 cents per liner, that seems like a good idea. But again, maybe not. Let's see. So this is what happens. What you need to do is look at the variable cost for you to make those liners and your fixed cost, so it comes to $125,000. If you buy the liners, we know the cost per unit is lower. It's 37 cents, so it's $92,500, but you're still going to have fixed overhead of $40,000. So you're only able to reduce your fixed cost by $10,000. So by outsourcing and buying that particular product, it's costing you $7,500 more than if you would have made it yourself. Because if you're making multiple products, you still have to have your facilities. You can't, shut everything down if you're making other products. So they managed to reduce their fixed overhead by $10,000, but it just wasn't enough. So while at the outset it seemed, oh, this is a great idea, it's, they can provide us the product with a price that's lower than what we can make it for. But you also have to take into account the fixed cost, how much of those costs will still continue. So the decision rule about outsourcing, so if the cost of making it exceeds the cost of outsourcing, then you would outsource. Whereas if the cost of making it is less, then of course you don't outsource. So another common decision is, should we sell the product as is or put it through additional processes whereby you can sell it for a higher price? So you have to consider how much revenue you're going to get for selling the product as it is now, how much extra revenue are you going to get if you do more processing, and then how much is it going to cost you to do more processing. So here, if you sell your product as is, so we're looking at an example of olive oil at $5 a liter, selling it as it is, you get $250,000. But if you process it more and make it into a gourmet dipping oil, you can sell it for $7 a liter instead of $5. So that gives you revenue of $350,000. But there's a cost to get that product converted from plain olive oil to a gourmet dipping oil, and that cost is $37,500. So to process it further, you would get revenue, the net benefit would be $312,000. So by processing it further, you're going to get a net benefit of $62,500. So you would do it. Again, the decision rule, to sell as is or process further. If the extra revenue from the processing exceeds the cost of the extra processing, you would do it. And if the extra revenue is less, then you would not do it. So the last issue that we address in the chapter is transfer pricing. So this is where there's multiple sections of the organization or divisions, and you need to determine what price you're going to sell your product or service for from one division of an organization to the other division. And you have to remember that you need to calculate what cost should a product or service be sold at in order to make it profitable for the selling department, but also make it realistic for the purchasing department. So you have to consider, does the selling department have excess capacity to supply what the purchasing department needs? Will the price be high enough to cover the cost? And will the transfer price be low enough for the purchasing department to reach its target profit goals? So it's kind of like a three-step process here. you would have to look at the minimum selling price. In other words, if you have the capacity to produce enough of the product that the department is looking for without affecting other orders, then variable manufacturing costs would be sufficient to set your minimum selling price. The maximum purchasing price should be what you would have to pay from another source. So if you're purchasing internally from one department to another, you don't want to pay more internally than you would have paid had you bought it from a company outside the organization. And typically, what the two departments would do is identify a range of prices and then basically negotiate something that's reasonable for the selling department and reasonable for the purchasing department. So if you have a capacity issue, and you could have capacity issues in several of these situations where for the special order or even for the transfer pricing and so on, if you're going to take on, say, the special order, what you have to look at is how much profit are you going to lose from orders that you're giving up, and also think about the future potential losses if the customer with the rejected orders moves all their business to another supplier. So transfer pricing, here you want to look at the minimum selling price that should be equal to or less than the maximum purchasing price. In that case, the transfer will take place. But if the selling price is greater than what you could buy it for from an external company, then the transfer should not take place. So that concludes the PowerPoints on this chapter.